Auditing is getting more complex every day. Demands from investors and other stakeholders for more transparency in how audits are conducted and for the management of reporting entities to be held to account for issues within the financial statements have made the job potentially a little bit more tedious than it used to be. But it's important to remember that an audit is not a guarantee that the financial statements are completely accurate. Let's look at the various audit outcomes or opinions that the auditor can provide. The best type of opinion a client can receive is an unqualified opinion, also known as an unmodified opinion. But even that doesn't mean that the auditor is claiming everything is perfect. Instead, it means that the financial statements give a true and fair view, or present fairly in all material respects, and have been prepared properly in accordance with accounting standards and applicable legislation to a reasonable level of assurance, not an absolute level. Where the auditor is less convinced by what they've found, they may opt for a qualified opinion, also known as a modified opinion. When the auditor decides a qualified opinion is necessary, it means that there's an issue in the financial statements that hasn't been resolved. There are three types of qualified opinion: a qualified except for opinion, an adverse opinion, and a disclaimer of opinion. Let's look at when each of these is used. A qualified except for opinion is given when the auditor disagrees with an accounting treatment, the adequacy of a disclosure note, or other non-compliance in respect of a material item. In this case, the matter giving rise to the qualification is material but not pervasive. So, it's a big deal, but it doesn't totally discredit the statements. An adverse opinion is given when the matter giving rise to the qualification is both material and pervasive. This means that the financial statements shouldn't be relied upon at all. They're basically rubbish. Finally, a disclaimer of opinion means that the auditor cannot arrive at an appropriate opinion on the financial statements. This may be due to inadequate records or evidence, or some sneakiness on management's part. Either way, it's bad news. The auditor will give management every opportunity to address any issues creating misstatements and will only issue a modified auditor's opinion as a last resort. A qualified opinion is never a surprise. All in all, a qualified opinion will raise concern among investors, creditors, and other stakeholders. Some may even jump ship. So to ensure that doesn't happen in your organisation, it's worth keeping up to date on your CPD. Luckily, that's easier than ever.